One of the things that I'm the most interested in when I talk about investments is when big institutional investors are buying shares in stocks that I don't understand. And so today we're going to talk about Elliott Capital Management and Suncor Energy. Elliott has recently, in the last year, doubled their position in Suncor. It now makes up almost 11% of their portfolio. They talk a big game when it comes to their belief in Suncor, talk about the potential of this company, but the shares have gone nowhere since. So in today's video, I'm going to go through why I think they're still so bullish on this company, what kind of ideas they might have that make them so confident holding so much of this stock, and why you might be interested in following them if this is the space you want to invest in. As always, I'm not your personal financial advisor, so please do your own research before you buy anything. Just because it makes sense for Elliott doesn't mean it makes sense for your portfolio. I've got an article on the screen right here from Gen Alpha. This is a great analyst who covers a lot of these kinds of stocks. He covers a lot of the dividend stocks, the oil stocks, and specifically he has some thoughts on what is special about Suncor right now. Now, I can't pretend that across the board, all analysts are as positive. Actually, right now, if you go through Seeking Alpha, you'll find that the consensus rating on Suncor is a hold. That lines up pretty well with the yearly result. If you look at year to date, Suncor shares are actually down mid-single digits, let's say. So while this author is very bullish, don't mistake that for a universal opinion. But that makes me a little bit more interested in what exactly this author might have to say. Because try as I might, I could not find any recent analysis from Elliott themselves saying why they own the shares. So we're left in this spot where we're trying to figure out what is it they like so much about this one. Of all of the Canadian stocks in this space, Suncor is like lower middle end of the pack in performance. I mean, think about their sort of sibling, Imperial Oil, the other very similar company with a very similar track record. Those shares are up considerably while Suncor's are down a chunk. So what is it about Suncor? Let's see. Now, this author goes through a couple interesting things. He mentions that energy is undervalued versus tech, something we've talked about a little bit on the channel, and that Suncor is attractive to value and income investors. Suncor has made record production, disciplined cost control, and robust shareholder returns. Operational turnarounds, which is a big part of what Elliott wanted when they originally bought in 2022, have driven higher volumes at lower costs, which pushes them in position for sustained earnings growth. With a 4.2% yield, a low valuation, double-digit earnings growth potential, that they look compelling from a total returns perspective. So, energy remains a bargain sector as just a handful of multi-trillion-dollar market cap stocks like Nvidia and Microsoft drive the market's performance today. That's great for value investors as one can take advantage of market complacency around non-tech sectors and layer in when the majority of capital is heading the other way. I think this is definitely part of the story. A lot of the smart money, while they definitely have been chasing the returns of artificial intelligence, of technology stocks, even of some of the other high rises in the last little while. We've seen some pharmaceutical stuff going on, the hims and hers blending pharmacy and AI. We've seen defense explode in the last year or so. So there's all sorts of interesting areas. But I think there have been some contrarian investors looking to invest in spaces like this. Obviously, I think we would be considered among the group who are investing in this kind of area, the Canadian sector, the Canadian energy sector specifically, where we see low valuations and are finding deals while money's looking the other way. Suncor, which was last covered by this author in May, has had record production and refining output, disciplined cost control, robust capital returns. Market has agreed, reflected by Suncor's 9.7% total return since May, which is actually beating the S&P 500. However, if you zoom out, look at the year in total, it's still down on the year. Despite their current run, as the author publishes this article, they're at just 1.8% higher over the trailing 12 months. I think this is a little bit, we're at a little bit lower. I think we're like just a couple percentage points lower. I think we're down 1% over the last year. I'll show you a chart here just to correct myself, but year-to-date numbers are worse than the one-year numbers for sure. And it obviously carries a very reasonable forward PE and a 4.2% yield, which is actually really nice. For dividend investors, people looking for a nice, well-covered dividend, obviously they're happy with 4.2%. So this is the part that we're really interested in. So why Suncor, right? Like, okay, think about it this way. Energy industry is undervalued. Sure. This thing has a 4% yield. Okay. They're well covered and operate efficiently. Awesome. This sounds like we could be talking about any Canadian energy stock right now. So why Suncor? Why is it that some of the best investors on earth own millions of shares? Let's see. Obviously, we know that they're the leading, or they say a, but I'd say the leading Canadian integrated energy giant. So they have everything as part of their umbrella, right? Beyond what a company like C&Q does, where they might be the number one champion of the upstream production, they don't have quite the same mix of assets that Suncor does, because Suncor has production, yes, refining, yes, but they also have retail fuel distribution, very vertically integrated. They help capture profits across the value chain, gives it some resilience against commodity price volatility, which is, I think, probably the first thing that maybe Elliott would like, because right now, obviously, we've seen a considerable amount of commodity price volatility. And while a lot of what I'm investing in is planning to capture some of that price volatility on the upside over the next 5 years, it makes sense if you're looking at this from a more value perspective, from a more disciplined perspective, you have a slightly lower risk tolerance, you'd probably be really interested by buying something that has resilience against price volatility. Majority of their production is in areas with 0% annual decline, has no exploration risk, with 7 BBL worth of reserves, because it's BBBL. So like we're talking billions of barrels of 2P reserves. So like really, really, really high quality. We're talking years and years of production. They achieved a net debt target of $8 billion in the third quarter. That means they can allocate more capital returns to shareholders, returning nearly 100% of excess funds via share buybacks. So there's another interesting note. Another thing that as an insider, as a big institutional investor, Elliott would have something to do with. Because something that Elliott can do that we can't is put members on the board. They did this back in 2022. And obviously they like what those members have said and what they've been doing over the years. Because in that time, Suncor definitely turned it around a little bit. They went from a laggard to like one of the champs in the industry for sure. They definitely made the production efficiency changes that were needed. And they started working on shareholder returns. And I think looking at shareholder returns, when a company is willing to put their own cash flows directly back into their own shares, they say this is the best option. It's a really good thing for a lot of us as investors looking for income, as investors looking to, hold these shares for a period of time, right? Because it's the opposite of being diluted out. You're actually being rewarded considerably for owning the shares by a lot of what the company can produce now. And it means you are in a better position to be rewarded by future growth. They've provided $45 billion of cash returns to shareholders since 2015. Is over 70% of the average market cap in that time. So if you look at the sort of chart we see on the screen right there, you see the light blue line is Suncor. You see the bump up, that'll be 2022 when just, commodity prices for oil and gas just shot through the roof. And all of a sudden you had all this excess money to return. That's why that's sort of a different chart. But generally the trend is upwards. And it's, cumulatively a lot of money that has been accumulating in shareholder returns. And they have a manageable debt maturity profile where you see, yes, okay, $8 billion of debt sounds scary, but you've got almost $6 billion of that that's not due for 10 years. So they're in a good spot from that perspective. They continue to demonstrate with strong results. Upstream production reached 808. I assume that means 100,000 barrels a day during Q2, 800,000. Which is the second highest Q2 ever. For the first half of the year, upstream production was 831, setting a first half record. So again, really, really good. Their daily production rates are looking awesome. Not quite a million, but close. Suncor's downstream business also shared in success with record throughput. It's actually something we talked about when we talked about Cenovus struggling, is actually Suncor and Imperial. Let's be fair to them. They deserve some of the hype around them, but Suncor's done a really good job of production efficiency, and it's just made Cenovus look worse, honestly, by not being able to compete. Obviously, they have a 99% utilization rate despite having major turnaround activity. So even though they had to go through similar challenges or obviously unique to their company and their production and their business, but they also went through challenges that Cenovus struggled from, and they just did fine. Like upstream refining, product sales also achieved high second quarter and first half volume records, 603,000 barrels per day, beating the previous record by 15,000. They also demonstrate impressive cost discipline. First half operating costs fell by 135 million year over year, which is really, really big. Actually, a lot of companies you've seen not huge, but increases in expenses over the last couple of years. You think about the price of everything is getting more expensive. It makes sense for expenses to go up. Suncor's not had that problem. They've been very good about efficiency. Another thing that Elliott said they wanted, looks like they're getting it out of Suncor. So interesting there. Now, that's again not a super unique story. Hitting record production levels is awesome, but we've seen that from lots of the Canadian oil sands companies. A lot of them have hit records, maybe not to the degree that some wanted them to, but they did a really good job. Seeing them have their downstream business look really good is also not unique. It is beating some of their competitors in the integrated space, right? I mean, they're probably beating out Cenovus a little bit on that, probably beating out Imperial a little bit, or at least tying with Imperial at a much more reasonable valuation. Speaking of which, they have major turnarounds in Edmonton and Sarnia refineries that were completed ahead of schedule and under budget. You never hear that. Ahead of schedule and under budget. Man, if more things could work like that, the world would be a much better place. As a result, management expects their performance to improve from the bottom quartile in North America to the first and second quartiles. So they're also planning to extend intervals between turnarounds at other sites, including their base plant, which is sort of up by the oil sands themselves, up by Fort Mac, Syncrude, and Firebag. Reduce capital spending, boost production uptime. Importantly, they continue to target robust shareholder returns. Balance sheet remains solid, reflected in its net debt sitting at $7.7 billion, lower than the $8 billion target. Its net debt to trailing 12-month AFFO ratio is under 1 times. They carry an A- credit rating and a triple B plus rating from Moody's and Fitch. Basically, it's triple B1 and triple B plus, same thing from Moody's and Fitch. Suncor returned nearly $1.5 billion to shareholders during Q2, including $697 million of dividends and $750 million in buybacks. That means they have a 4.2% dividend yield, well-covered 48% payout ratio. It has a dividend compound annual growth rate of 7%, well beating inflation, something that dividend investors love to see. You want to see dividends beat inflation. This absolutely does that. They've reduced their outstanding float by a staggering 20% in the last 5 years. So on top of that dividend that you're getting, you're also seeing your shares increase in value. And I mean, if you looked at a total return chart, it would look better than a price chart. Lastly, they see value in Suncor at the current price of $39 with a forward PE of 14, sitting below its historical PE of about 17. So if you look at historical metrics and you look at where we are now, we're a little bit undervalued from a historical perspective. At the current valuation, it appears the market continues to underappreciate the value of Suncor's significant turnaround activities, significantly boosted production while lowering costs. So this could be the hidden piece, is that, well, they've made a lot of the same kinds of numbers as, let's say, a CNQ or, man, like even a Whitecap, an ARC. They've had similar records to show. They're saying, hey, we got record production. We got record refining activity. We've got record retail sales. A lot of other companies can report the same thing, but because of acquisition. Suncor hasn't been a large acquirer yet. We'll get there, but yet. But they've managed to hit the same record numbers, and it's because of efficiencies. So you're unlocking value that already existed in the assets in the company, becoming more efficient and reaching those records. It also puts them in a nice position from the perspective of dilution, of valuation. It puts them in a nice position in returns of long-term debt. They're just in a really good spot. And it puts them in a future position where they can continue to grow. And importantly, they can continue to make big moves when the company needs them to. With their 4.2% yield and the base case expectations for at least 10% earnings growth annually, which is very, very, very reasonable. I think, honestly, in the sort of image that we see happening in the Canadian oil and gas space of, maybe new pipelines getting built, at the very bare minimum, more support for the industry, more financing for the industry, the reduction of all these measures that have slowed down growth. I think you could see that accelerate in the next 3 through 5 years compared to the next 1-2 years. But again, 10% is a reasonable number. It's nice to plan on a lower number, and then it maybe experience the more positive moves. Suncor could readily deliver double-digit total returns annually, which is big. If you think about where the Canadian market's been for the last 10 years, we've been looking at low double digits returns on a compound annual growth rate basis in the overall TSX. So if you could see like solid double-digit returns from a company like this that's offering a great dividend, I would be happy with that. And they estimate a 12% EPS growth next year. Risks to Suncor include oil price volatility. A sustained drop below $50 a barrel could pressure margins. It's going to pressure everyone's margins. In that case, I think there would be maybe some sort of reward for being such a lovely low decline business. In their case, I think they, like a CNQ, would end up finding themselves in a better position in that case. But again, there is a risk there. Obviously, talk about climate policy, stuff like that. So author here thinks that it's an attractive opportunity for value and income investors. Rare blend of strong fundamentals, disciplined capital allocation, discounted valuation, supports shareholder-friendly policies with dividends and robust share buybacks. It benefits from years of operational turnarounds that are now driving higher volumes at lower costs. They have record upstream and downstream performance, industry-leading utilization, and they could deliver potential double-digit earning totals from its low valuation, dividends, earnings growth, and share buybacks. Makes it a compelling value stock. Now, I think that's a really interesting point to make, that Suncor's position is continuing to unlock value in a way that's not flashy. They're not making these big moves and these big deals that have really sort of become standard in the Canadian oil and gas industry over the last year. You haven't seen them go out and try to buy Mega Energy. You haven't seen them go out and, acquire all these oil sands assets from people who are leaving. That was Canadian Natural. That's been Strathcona. That's been all these other names in the space. But I don't know if they might not have an ace up their sleeve, because there have been whispers. And they're just whispers right now. No matter who I talk to, nobody can say that this is certainly going to happen. But there have been whispers that Suncor might look to acquire Cenovus. Now, big disclaimer here. This is complete speculation. But I think there is definitely potential that somebody who might happen to own a big chunk of the company, who might happen to have a couple of board of directors spots, might be interested in seeing if they can't take this incredibly, cutthroat efficient team and use that cutthroat efficient team with all their great assets, with this huge vertically integrated network, and go out and at the very least get some of these underperforming, low price Cenovus assets. And I think probably the best way to do that would be to buy the whole thing. And if you think about some of the moves they've done, they've put themselves in a good debt position. They've put themselves in a position where they've bought back a huge number of shares. Both of those moves could make them an obvious acquirer for Cenovus. Now, I'm not going to pretend that Cenovus would be bought cheap. I think it would be a big jump from, what we've seen with Meg, or even the Whitecap Varen deal, or any, the Parkland deal, any of these deals that we've seen in the Canadian space in the last year. I think Cenovus would be a step change larger, for sure. It would be a much bigger deal. But if they could maybe get a world-renowned investment manager on side, and they could maybe put themselves in a position where they've returned great value to shareholders, proven themselves great at running turnarounds on vertically integrated oil sands stocks that need to pump some efficiency into their assets, all of a sudden it becomes a little bit obvious where the value could be for shareholders if they were to do a move like this. Now, I can't pretend to know fully that that's exactly what's going to happen, but every time I ask people who are sort of in the know in the industry, who talk to people often, it seems to be a recurring trend. And it's clear that somebody has said something or somebody knows something, because it's always Suncor linked to buying Cenovus. It's not, Cenovus could be bought. It's literally people out there are whispering about Suncor's opportunity. So I think there's an interesting storyline that we could follow there. And I think Elliott Capital Management doubling down on their Suncor position last year and then sitting on it, not changing their mind no matter what has happened this year. Think about all the things that went through in 2025. We saw tariffs. We saw oil prices fall. We've seen OPEC try to flush shale oil out of the market. We've seen, considerable shifts in the Canadian political climate. We've seen so much happen. And Elliott sat on their hands. We've not seen a press release. We've not seen, even a share, like a small, trim of this position in order to chase after faster growth or better value that's appeared either internationally or in the US or any of that. They've sat on their hands and kept almost 11%, almost 12% of their portfolio in a Canadian oil stock just because they've managed to gain some efficiency. And while Suncor shares haven't given them the kind of returns I'm sure they hope for, and honestly haven't given any of us the kind of shares we've been looking for, these guys are still on board. They still see value here, and I'm really interested to see how that plays out. So if you are a Suncor investor, let me know what you think of the company. Do you like the efficiencies that have been going on? If you are looking for other interesting oil and gas stocks, I made a video recently talking about ARC, and their just great position in the market, incredibly cheap stock. It seems a little overlooked. It might have a great couple of years. So if you want to check that out, I'll link it in the description below. And as always, I hope I see you in the next video.